Hey guys, Omar Khan here with Theta Trading, and today's topic discussion is the 2023 stock market outlook. We're going to give our best idea as to where the stock market's going. It's very difficult to predict short term. Nobody really knows, but we're going to take a look at the short term picture and we're going to take a look at the longer term trend, okay? And why it's a great idea to invest in the stock market long term. All right, before we get on today's topic, I got to ask you guys a huge favor. Could you consider hitting that like button? It helps promote our videos to other people who are like-minded. It helps the algorithm out. Consider subscribing to the channel if you find the information to be useful. And also hit that bell notification for future videos. Now, let's get on to today's topic. 2023 stock market outlook. So I'm going to look at this one chart we have here. On the S&P 500 index at inflection points, okay? Now this chart goes back all the way to 1996, a long time ago. And you can see here, this is the S&P index, okay, which is the S&P 500, the largest 500 companies in the United States. You can see that index back in 1996 was around 750. Currently today, we're just shy of 4,000. Okay, so you can see the market has gone up around six and a half times since 1996. That is a lot more than it was in 1996. But the market can do some really wonky things in the short term, okay? So let's take a look at this chart. I graduated university in 1998, and I was part of the 2002 market decline. It was really painful. So let's take a look at what happened. From 1996 to March 24th of 2000, when the market peaked, we had a gain of 106% over those years. And I'm going to talk about something called forward PE ratios, okay? Now that's a term. It's the price earnings multiple. It's basically how much is someone willing to pay for a company. Like if a company makes $1 and I say, oh, I'm willing to pay 10 times that $1 to buy the company, well, then that would have a PE ratio of 10 to 1, depending on what I'm picking. So if I'm buying the stock at $10 and they're making $1 a share, that gives me a PE of 10. Now, let's take a look at March 24th, 2000. We can see here that the PE ratio at that time, the forward PE ratio, which just means looking ahead 1 year, was 25.2. That means for every $1 of earnings of how much a company made, people were willing to pay 25 times that much. And in 1996, they were only willing to pay 16 times that, 15.9 in fact. So what does that tell you? That tells you that people were overpaying for a lot of stocks. They're paying a lot of money, and that's what happens when you have bubbles and market, when the market goes, has a substantial bull run. There's two ways to increase, stock prices. One is if the earnings of the company continue to go up. Okay, that's something we always look for. Secondly is if someone is willing to pay more than they paid previously. Like again here, you look at 1996 paying roughly 16 times earnings. And by March 24th, 2000, 25 times earnings. Substantial difference. Now the correction occurred. And I was working in the industry back then, so I fully felt this. It was very, very painful. The market went down 49%. Got cut in half. The NASDAQ got cut down by 80%. It was terrible, brutal. But at the end, that PE multiple went down to 14.1. And that's when the market said, you know what, that's enough pain. These are now reasonable levels that people are paying for stocks. And the economy also got better. 2000 to 2002 was a period of economic recession, right? So the market finally bottomed in 2002 and it started taking off again. And it did so until about 2007. You can see it went up 101%. And the PE ratio in 2007 was quite reasonable at 15.1 times earnings, okay? But what happened in 2007? 2007, you look at and you see a huge financial crisis. That was the credit crisis. If anyone's ever seen the movie The Big Short, that kind of sums up what happens. In the United States, mortgages were being given out to pretty much anyone who could, put fog in a mirror. And not much credit checks were being done. Not much underwriting was being done. Everybody was basically getting mortgage. And people were buying 2, 3, 4, 5 houses. And then that was making banks a lot of money, and that what they did is they packaged all this debt, which was horrible debt because it should never have been lent out in the first place, and they sold it to different people around the world, and that caused a huge problem. That was the global financial crisis, also known as the Great Recession. So entering that, we were at 15.1 times earnings, okay? And then out of that, we came out March of 2009. That lasted for about 19 months. It was horrible. I remember it vividly. It felt awful. And when you're in the middle of these really bad stock market declines, it feels like it's never going to end, but they all end. Now, March 2009, you can see the PE ratio, forward PE ratio of 10.4. It was pretty cheap, right? And the market had really, really gone back down, almost back down to the levels, pretty much back down to the levels it was in 1996. So you lost about 12 years of gains. That was horrible. But look what happened after that. March of 2009, the market bottoms out at 10.4 times earnings. Now think of what a big difference that is. In 2000, you were willing to pay 25 times earnings for $1 of earnings. Now you're just willing to pay 10.4. So the market becomes really cheap on a relative basis. And after that, the market rallied from 2009 all the way to 2020. And it went up 401%. Huge increase. Okay. Now, February 19th, 2020, the whole world shut down. COVID happened. Forward P ratios were at 19.2. Okay. And the index was at 3,386. Substantially higher than it was in March of 2009 at 677. So the market did amazing for a number of years. Now, it had its pullbacks in between, but you did really, really well. If you had bought in March of 2009, and held all the way there, you're looking at over 5 times your return on your money. 5 times. That's 500. That's a lot more than you put in. Now, at 19.2 times earnings, one could argue, well, yeah, it's pretty expensive or it's relatively okay. It wasn't anywhere near as bad as the 25.2 you had in 2000. But COVID happened and the whole world shut down. And central banks around the world, in order to prop up the economies of the world and make sure people don't starve and kill each other, had to start printing a bunch of money and handing it out to people. Say, here, take this money. Just don't leave your house. We don't know what's going on. This could be horrible. And it was horrible. A lot of people lost their lives. It was awful. In March of 2020, the market went all the way from 33.86 and it declined by 34%. And then we had a forward PE of only 13.3. Okay? And then the banks around the world, like I said, they started injecting money. The world started opening up a bit here, and the stock market again took off. In January 3rd, 2002, that's when we peaked here at 4,797 on the S&P. We were at 21.4 times earnings. You can argue, okay, well, that's value. That's too expensive, or it's not too expensive. It's pretty much in line, maybe a little bit on the expensive side, but it's in line with what the market has been over the last number of years. But what happened? Because of all that money printing, we had this nasty thing called inflation. That's what we're mired in today. We have high levels of inflation, although it is coming down. It peaked around 9% in June, and today's reading, we had only a 6.5% inflation report. That means inflation is 6.5% higher this month, in December of 2022, which is the last data month that came out, versus December of 2021. Okay? And we have had a 20% decline in the S&P 500. So now we were at just under 4,000 on the S&P. Still substantially higher than the 741 we started off in 1996. And only 16.7 times earnings. So you could say, well, is it going to go lower? You don't know. The main thing, can it go down to 13 times earnings, 12 times earnings? Sure it can. In March of 2009, it went all the way down to 10.4 times earnings. So, and if you use that metric, we're still substantially higher than we were back then. But it's a different universe now than it was back then. We don't have a financial crisis. We have an inflation issue. So the banks around the world started increasing interest rates. Money printing got out of control. People started buying all kinds of the crazy stuff. And that raised the price of all kinds of items, foods and services. And we've all seen this at the grocery store, the gas station. Prices are substantially higher. I just did a video on the CPI. And if you want to look at inflation more in detail, check out our last video. Now, we're at 16.7 times earnings. So what is the market telling us on a go-forward basis? Well, the market is saying if interest rates come down, and it looks like they might at least stabilize and hopefully start coming down in 2023, then we are in a pretty good spot going forward. That means the stock market can resume its upward long-term trend because markets don't like uncertainty. And the uncertainty you still have right now, to a lesser extent now than it was a few months ago. But there's still inflation everywhere. And they want to get inflation down to around 2%. And like I said, we're at 6.5%. So the outlook for the stock market this year, the market is a forward-looking mechanism. It reacts very positively if interest rates decline, right? So if inflation and interest rates peak and now are coming down, the stock market is going to love that. And generally speaking, the year after a terrible market like we've had in 2022, the markets generally do quite well. I've only seen one period where it was, 2 years of negative returns, and that was in the early 2000s. That was awful. But again, it's not the same thing this time. It's different. It's different every single time. Now we're at 16.7 times earnings. The concern is now, are earnings going to start declining? Because if people don't have money to spend and they don't have jobs, well, how are they going to buy stuff, and how are companies going to make money? That's the major question right now. And reality is nobody knows, not even Warren Buffett. Warren Buffett was down substantially in all these periods as well. But long term, he's done great, because short term, the stock market can do anything. In the long run, it has a trend upwards because our lives continue to get better. Companies keep making more money, and there's a bit of inflation there too. So my theory is that the stock market is already starting off the year of 2023 pretty well. And why that is it's anticipating, and the bond market is confirming this, that interest rates will not only stabilize, but maybe even come down in the second half of the year. Now, if the stock market's a forward-looking mechanism, pricing in today what thinks is going to happen in 6 to 12 months, if interest rates start falling down, people are going to start buying stuff again, corporate profits are going to increase, there's more optimism, meaning people are willing to pay more. That PE ratio that we talked about, they're willing to pay more for a company. Instead of 16.7, can it go back to 21.4? Sure. People are willing to pay more money, and companies make more money. That means the market should go up. But that is all going to be dependent on inflation and interest rates coming down in 2023. And like I said, so far so good. We've gone on the right trend. The major concern, though, is that if interest rates stay high for a long period of time and they're not able to combat inflation, well, then the market is not going to look at that very favorably. It's going to say, well, people are really hurting out there. And we could have this nasty thing called stagflation, which is a stagnant economy and high inflation. It doesn't look like it's trending in that direction. It looks like inflation, like I said, is coming down. I just did a video on it. Take a look at that video. Going from 9% in June all the way down to 6.5%. And that trend has been pretty much downwards. Hopefully that trend continues. And what I'm hoping for is the second half of the year, like I said, the central banks around the world, including the Federal Reserve in the United States, say, hey, we've got this inflation genie back in the bottle. It's under control. We're close to our 2% target. We can take the foot off the gas in terms of increasing interest rates and actually start decreasing them. Because if interest rates stay sky high as they have, relatively speaking, for a long period of time, it hurts people. It hurts people financially. I know so many people who are feeling this. This is very, very painful financially. And when you're in pain financially, you're not going to be spending. Therefore, no inflation. So in the second half of the year, I think inflation will start coming down. Interest rates will start coming down. Inflation, I think, has already peaked in June. And that bodes really well for the stock market in 2023. But we still have a lot more data to come out. But look at the longer term picture here, guys. Look at 1996 to 2022. If you just left your money and just not even thought about it, didn't worry about what the market's telling you, you have, like 741 to 3840. That's a big, big increase. And that's why the stock market long-term, I think, is an excellent vehicle to invest in. However, short-term, horrible things can happen. Invest in good companies. Hold for the long run. If you like what we do here at Theta Trading, please consider booking a call with us. We'd love to discuss this with you further. And until next time, Omar Khan from Theta Trading. Talk soon. Take care.